In terms of the domestic side of the Canadian economy, I think consumer spending is going to be solid. Business investment could be quite robust as profits pick up, and the fact that imported machinery and equipment is getting cheaper because of the strong Canadian dollar. And here's a real opportunity for businesses, because if you want to invest in new capital, new machinery equipment to boost your efficiency and your productivity, 80% of machinery and equipment in Canada is imported, and it's just been made a lot cheaper by the rising Canadian dollar. So ultimately, I think we could see significant gain in business investment in the coming year. In terms of the Canadian housing market, we've been getting a lot of strength lately. In fact, it's quite surprising how strong the housing market has been in an environment where the unemployment rate has been rising. You know, traditionally, when people are worried about jobs, they don't go out and buy houses. But what has happened is because interest rates came down so low, because the Bank of Canada took the overnight rate down to a mere quarter point, mortgage rates came down to levels that were absolutely unheard of. And so when the fear dissipated in the late part of last year and into the spring of this year, what ultimately happened was it drew buyers back into the housing market because they could see that the mortgage rates probably were too good to last indefinitely. And so we saw a big improvement in affordability. Home prices were falling at a time that mortgage rates were very low, so affordability really got improved. Buyers came back in, and that's really propelled the housing market forward. In fact, we got back to seller's market territory in a lot of regions. Now, the question is, where do we go from here? Well, there's a bunch of reasons to think the housing market's going to cool down a bit. The first is that what you had was some pent-up demand, and that was created by the fact that the housing market had weakened in 2008. And so buyers that put off buying in 2008 have been pulled back into the market in 2009, but probably at least half of that pent-up demand has been absorbed. The economic fundamentals for housing are going to remain sort of a challenge because we've seen a big loss of jobs in Canada, and the unemployment rate is probably still going to be rising over the coming months. Although we saw a dip in the unemployment rate last month, as I said, you have to watch out. Labor market conditions are a lagging economic indicator. So we could see some renewed weakness in employment and the unemployment rate over the next few months. And even as the economy recovers, I think it's going to be a very slow grind down for the unemployment rate. So I think that the economic fundamentals, while being supportive for housing, are going to basically suggest that the housing market should cool down from the rate of growth in sales that we've been getting. So whereas home prices are now rising at a double digit, I think we're probably going to see that home prices are rising at about a mid-single digit pace, something around 5% in the coming year. When we look at the labor market in Canada, I think that it is going to remain relatively soft over the coming year, but gradually the tide will turn, jobs will start to be created again, the unemployment rate will gradually decline, but it's going to take several years before we get back to the unemployment rates we were seeing. Now this is actually a positive thing for small businesses, because when you talk to small and medium-sized businesses before the economic weakness in 2008, one of the biggest challenges was the fact that they were having difficulty finding and retaining high-skilled staff. So ultimately, I think that from a business point of view, the labor market is going to probably be less of a challenge than it had been prior to the recession. The bad news from a worker point of view is that unemployment rates are going to remain relatively sticky, only declining gradually. The fact that the unemployment rate will be slow to decline, combined with a moderate pace of economic growth, basically says that there's going to be a lot of slack that's built up in the economy that will be very slow to be absorbed. And the reason that this is important is it means that inflation really shouldn't be a problem. In fact, inflation, which is likely to grind lower over the next 6 months and then only gradually pick up thereafter, is still going to be below or close to the Bank of Canada 2% target. And that means the Bank of Canada can live up to its conditional commitment to leave interest rates on hold until after June of 2010. And in fact, it makes my life a lot easier as an interest rate forecaster when the central bank tells you what they're going to do with interest rates. Right? They basically started in the midst of the financial turmoil. They made a commitment that they wouldn't raise rates before June of 2010, and unless they really get spooked by inflation, or if the housing market continues to accelerate if the housing market accelerates from the current levels. That's the sort of thing that could prompt them to go earlier. But the bank, like ourselves, believes the housing market will cool down, that inflation won't be a problem. So interest rates are going to remain extraordinarily low until we get to the middle of next year. And then I think that they will start to gradually raise rates. But I think it's going to be a very slow, very gradual rise in interest rates thereafter. So in fact, from a borrowing cost point of view, from a business point of view, borrowing costs are going to remain extremely low for an extended period of time. So with that, I've tried to summarize the outlook as well as I can in the allotted time. Thank you.